Alrighty. Hello, everybody. I'm Boss, Joe Boss, and welcome to another daily plan. And today we have FOMC, the big event. Now, just to lay the ground here for what we are expecting, the Fed is gonna hold rates. They're not expected to hike. They're not expected to cut. They're not expected to do anything but stay put. However, what people are watching the FOMC announcement for is two things. The Survey of Economic Projections, the SEP, which is a quarterly report where the FOMC updates their expectations on future economic growth and their outlook for out into the future. And that can help set policy expectations for how much the Fed will cut or won't cut. Of particular interest is the dot plots. So, generally speaking, my expectation will be, okay, the Fed's going to have two Fed rate cuts priced into their dot plots, which is their future expected rate path. And that seems to be, frankly, the consensus. Nothing terribly huge there. However, if we get any commentary on growth uncertainty, mostly due to inflation uncertainty from all of these crazy surveys we've been getting, which we'll go over recently here, you'll actually get to see the data, and employment uncertainty, which also is kind of indicated by these surveys. So this is going to, at the moment, keep the Fed on hold. But I wouldn't be surprised to see a couple of people at the Fed say, hey, I'm going to stay on the more dovish side and expect a third rate cut. So we'll see how many members of the FOMC expect 3 rate cuts. That would actually be kind of important to know. If we get one cut here going into the June meeting, and then when we get the next series of economic projections, the next SEP report, and then 2 more in the latter half of this year, depending on how growth and employment actually turn out. So these are longer run expectations that we're focusing on. However, don't miss that, just because we have outlooks and forecasts that go out 6 months to a year, that somehow doesn't impact how prices move today. My main thing here when it comes down to trading, and one of the things that's helped me personally a lot with getting better at trading, is to understand trading is getting exposure to a change in expectations. So if you can see a change coming around the hump over here, coming around the hill, and you get exposure to it, and it actually happens, well, that's how a lot of people make money, frankly. Getting exposure to a future change. Do your best to anticipate when expectations are likely to change or continue. And then, at least I do my best to try and get exposure to that. And one of the big expectations here is around US growth, which is why we're focusing so hard on what the Fed has to say about their views on employment and inflation. So then we can see how they're going to view, okay, here's how we're going to probably adjust our monetary policy going forward, given these assumptions. And if we get data, for example, if they say something along the lines of, all this tariff uncertainty, all this inflation uncertainty, all this employment uncertainty is likely going to hurt US GDP growth. And we actually have something here in the Discord that I brought up in yesterday's stream. If I go to the economics tab here, you can see here are the surveys. We went ahead and looked at these economic surveys not too long ago. Let's see, where you got a lot of economic data here also on Australia. If you want to learn a bit more about Australian politics and Australian economics, for example, if you're taking a look over here at Aussie dollar and you're wondering, wow, this thing, it went up so much and now it's coming down so much, right? Well, that's a bad expectation, that's a bad expectation. Well, guess what? If I had watched this Roy Morgan weekly update, I probably wouldn't have set this expectation, because in that stream I said, oh, you know, I don't think there's going to be such huge tariff threats against Australia. Well, it turns out that the aluminum and steel tariffs are likely going to be placed on Australia, and I had apparently missed that. But I wouldn't have missed it if I actually watched that video when it came out on time, or if I was paying closer attention to the research thread that we have here on Trump tariffs. Right? You can see all the stuff here talking about all these tariffs, and this is actually a special report from G Captain, which is actually a shipping news organization. And they're like, hey, we could actually see some really bad negative economic impacts if we start seeing blockades of a few of these very, very important shipping lane checkpoints, which kind of was a major reason why Trump went after the Houthis recently. And then you can see, yeah, here's some commentary on Carney. That's a Canadian thing. There's a lot going on about the world. And then here's Anthony Albanese, the Prime Minister of Australia, talking about tariffs and saying, hey, we know we're going to stand up against these tariffs and for Australia. So there's a lot of information here. And sometimes, even for me, I forget one or two pieces of information, and it can lead to setting a bad expectation. But the whole point is you set your expectations, even if they're wrong, and you keep track of them over time. So that then you can learn, oh, I forgot a piece of information. Oh, I had all the information there and I set good expectations. Or even though I missed a couple of things, things still worked out for me because of X, Y, and Z. And you can track where your weak and your strong points are in how you do analysis, in what you actually know about the assets that you're trading. And that's frankly why this Discord is free. Simply because it's very, very hard to do all this work on the retail side of things and to get this information as quickly as possible. So that's why this is a free research and geopolitical and outlooks focused Discord. Now, we do a lot of trading still in here. Actually, there was a post here from Isaac not too long ago. He's got some cool stuff going on over here. He's sharing his longs and his shorts. Thank you very much, Isaac, for that. And again, if you want to go ahead and suggest stream topics or share trading results or share trade logs, I can cover them here on the stream if you want. And you can see we also had some news here on crypto. SEC dropped its appeal against XRP. Oh, let's go and check that XRP USD. Yeah, check that out. Big fat candle. It's up 8% just in the last 6 hours. Based on the ranges, looking at this on the week, that I would not be surprised if that's actually the top for the week. But again, given the positive momentum, I also wouldn't be terribly surprised to see further continuation, because that lawsuit has been a pain in the butt for XRP for a very, very, very long time, for many, many years. Effectively, the lawsuit was trying to figure out if XRP qualifies as a security. But now, with the Trump administration coming in and saying, hey, any confiscated XRP goes into the United States Crypto Reserve, well, now, along with 4 others, Bitcoin, Ethereum, Cardano, and Solana, all these are up on the day. Or, of course, XRP is up 10% on the day, ADA is up 4, Sol's up 5, roughly. Bitcoin's up a few percent. It looks like it's holding in here on Bitcoin's side, don't you think? Bitcoin seems like it's holding in there. I think all the guys calling for 60K might be a bit upset, unless we see truly terrible US GDP growth. Just playing around with the sound. Alright, let's go ahead and check out what's going on here on... Alright, Kick is holding up well, and Twitch. And just gotta do some live checks on the streams here. Oh! Twitch went offline for some reason. I didn't turn it off, did I? Yeah. Oh man, I'm very, very happy to see that my spam bot filters are working on Twitch and Kick now. I see like 5 or 6 messages that got caught by my spam filters. Good job on my end. Good job on my end. No more spam hopping into these chats here. Okay. So yeah, that's a bunch of things going on. That's just a bunch of things going on. We have a lot of time to kill until FOMC comes around. We have about 41 minutes. Now that might seem like a lot of time here, but we got quite a few things to go over to help us set better expectations for what to ultimately expect here. For the DXY. Oh, and check that out. Looks like we hit a peak in our probability distribution right here. Yeah. That looks like a likely low for the week. So let's play a little game here. If that is the likely low for the week, and I'll just reduce the information that's on the chart here temporarily. Let's remove the low dots. We got another indicator here on the chart called timing dots. The thing I just removed are the range probability indicator. And now we have the timing dots on. So this is saying, okay, given a low somewhere in this green box, where do the respective tops for the week come in at? And these are some potential tops. Now, just looking at this, I see a whole bunch of dots right here. So this means going up into the end of the week and effectively just having a big fat closing bar. Effectively a bar that looks like this. And then a little wick down here. And then maybe a little top wick like that. So this is what the weekly bar will probably look like if we give this expectation a try. Now that would be in the case that the Federal Reserve is still highly uncertain about GDP growth and says something more or less along the lines of, we're going to remain with our same policy, the economic data still looks good, we're concerned about the surveys, but until we actually see actual bad data come in, which it definitely could, sometime for the month of March in the April CPI and employment numbers that come out, and then later on in May. So the April and the May CPI and employment numbers for the US are going to be very, very closely watched, and those are going to likely have quite high volatility. If we go and check out options and futures pricing for events that expire just after, contracts that expire just after those economic prints. Because those will massively, massively inform our views of what the Fed will likely do in the rest of the year, and if we're actually going to see the negative growth impact from tariffs that all these economists are expecting and all these analysts are expecting. However, there is some hope. We're seeing, I believe, some commentary out of there is a, if I recall here, yeah, right here, US tariffs. Fox correspondent on X, White House economic advisor Hassett, says he spent last night with the Commerce and Treasury Secretary negotiating with other countries about mutually lowering tariffs ahead of the April 2nd reciprocal tariff deadline. That would reduce the current amount of expected inflation impact hitting these countries from US tariffs if these negotiations go well. The fact that these negotiations are occurring is a nice positive sign. We can actually, by the way, anyone who is part of the trading group or in the Discord is going to get access to these notes here. So these are just the stream notes. I did mention something along the lines of these consumer surveys setting harsher expectations for the US economy going forward. But I have to preface before going into this that Powell did give a speech, I believe, last month or earlier here into March, saying that the relationship between the direction of consumer sentiment indices and consumer inflation and employment, all these surveys, they say things are supposed to get better, but the actual data hasn't actually printed worse yet. And that the correlation hasn't been terribly strong. However, seeing this kind of rise in expected inflation a year out, this is from last week's Michigan Sentiment Survey. And this is their expectation of, hey, where's inflation going to be a year ahead of time, right? For consumers. So this is pretty bad. This is really bad. The highest reading since November 2022 and marking 3 consecutive months of unusually large increases. And then we have another one. This chart looks a lot less interesting, but this is the expected change over the next 5 years. So this could be viewed as the long run expectation for inflation from consumers. And this is the largest month-over-month increase ever seen since 1933. So inflation expectations from consumers are rising, and either inflation in the US gets put under control immediately, which is partially what Trump is trying to do with importing more eggs into the United States to help get egg prices down. Right now I'm seeing posts on X about these large lines going all the way around Costco's for people trying to pick up eggs. It's kind of nutty. So for these inflation expectations to actually come down and to not do serious harm to the Fed's loosening, right? The Fed wants to get into a rate cutting cycle. They want to cut rates more, but in order to do that, they need to make sure employment doesn't get hit hard and inflation doesn't increase and come in super, super hot. So right now, consumers are expecting higher inflation. They're preparing themselves for higher inflation. But a lot of the tariff negotiations and geopolitical issues that are pro-inflation are in progress of actually being managed, right? The Russia-Ukraine war. I know the thing going on with Gaza is re-escalating, which isn't great. That could be inflationary. And then you also have what's going on with the Houthis, Trump coming in and telling the Houthis effectively to stop and threatening them with even more violence. But the Houthis is especially important because that's reopening the shipping routes between Europe and China. Believe it or not, the shipping routes that the Houthis are blocking more impacts Europe inflation and Chinese inflation. And if their inflation can be managed, it's actually going to mitigate and hit at the margin the negative impact from US tariffs, which net would be a good thing. And then if these countries can come together, like what this guy here says, what Hassett says, about doing negotiations from now until April 2nd to try and reduce the current level of tariffs, so then the reciprocal tariffs when they get put on aren't insane, that would bring down the expected inflation even more. Now, until we actually get some agreements, until we actually get some news, it's not going to really improve expectations that we'll actually see that turnaround in inflation. But either this turnaround in inflation has to be generated like now over the next 60 days in order to mitigate upside surprises in US inflation and inflation in other countries, frankly. Otherwise, we could see global growth get hit a lot more. But if all the good things that I'm saying come to fruition, we'll end up with economic surprises to the upside on growth and at least inflation not coming in as hot as many economists who expect all these tariffs to come into full effect would be expecting. And I hope that is enough to say, hey, if you like this commentary, make sure to check out Plan the Profit here on WAP. Link is pinned already in all of the streams in Twitch and Kick and in YouTube. And then, of course, if you want to try out these indicators, you can try them out for 10 days for free. It gets you access to the trading group up here, where we do more in-depth research trying to apply the things that I'm talking about. And of course, a lot of, like 95% of all the research we do is free. And you can see right here, outlooks. We actually posted a few more new outlooks here. Bank of England preview. We're getting Bank of England stream tomorrow, guys. Bank of England's coming out. So we'll probably want to read this on our own time. CTA dashboard, looking at CTA positioning. And then BlackRock actually came out and said they were still overweight equities. I actually put it here, forwarded it, and quoted it. Recent volatility has been exacerbated by policy uncertainty for investors moving out of crowded positions in equities. For example, last week we saw a rapid move away from popular trades like the tech-heavy momentum equity style factor that had some of its sharpest declines since the pandemic. You know, NVIDIA, right? NVIDIA, let's just say it. But over time, deleveraging will have run its course, and uncertainty will likely ease as we get more policy implementation details, such as the White House's full tariff plan due in April. Then, some of the risk premium investors now want for extreme uncertainty could be priced out again, essentially saying, hey, volatility could be coming down in the future. And this is a free piece of commentary. This is free for anyone who can click onto these links here, click on the BlackRock, check it out. I mean, it's kind of amazing how some of these largest, most influential groups have research that's freely available, and you can read what they're saying and what their expectations are. It's just most people don't know where to get this information. So here it is, right? I'm one of the guys who knows where to find it. I'm one of the guys who knows where to look for it and how to help interpret it. And most importantly, you can see how I interpret it, you can read it for yourself, and then we can actually have a discussion and build up our edges. Build up our, not necessarily trading alpha edges, I mean our edges as far as being able to actually interpret these things well in setting our own expectations. I know a lot of guys aren't, super into, aren't super into, I know a lot of quants that are actually on the more elitist side who say, why bother reading all these outlooks, right? All these outlooks are usually wrong. Well, guess what? If you read a bunch of outlooks and a bunch of expectations, and a lot of these outlooks and expectations are also written by heads of research, people who are quants in these firms. Like, you're not just getting any old analysts in these firms. And a lot of these longer term expectations are based on reasonable assumptions. But if you don't know what those assumptions are, going into these markets and setting your expectations based on those things without understanding the assumptions, well, guess what? There are quantitative strategies that don't even take this information into account. And qualitative information, I mean, that is important. Like, what is Trump doing right now? How is Trump changing expectations? What did he most recently say here over on Truth Social? Reports are coming in. This is from Trump earlier today. Reports are coming in that Iran has lessened its intensity on military equipment and general support to the Houthis. They are still sending large levels of supplies. Iran must stop the sending of these supplies immediately. Let the Houthis fight it out themselves. Either way, they lose, but this way they lose quickly. Tremendous damage has been inflicted upon the Houthi barbarians, and watch how it will get progressively worse. It's not even a fair fight, and never will be. They will be completely annihilated, right? So when it comes down to stuff on the Houthis, like, again, you can decide not to like Trump. You can decide not to like Le Pen. You can decide not to like Guaido. You can decide, not to like all these guys. Oh man, I was about to say, Nigel Farage there in there, but I'm not so sure nowadays. If you go ahead and check out the UK, the United Kingdom general election thread that we got going on here, there's kind of a break going on in the Reform Party, which is the party that's supposed to be more MAGA-like, and it seems like Rupert Lowe, everyone wants to try and get Rupert Lowe in. Nigel is fighting tooth and nail to keep his position in Reform. You have a bunch of guys from the Tories trying to hop in over to Reform. There's a bunch of weird politicking going on in Reform, and we have a thread here set up to watch any news that members here in the Discord are finding out about it. Also, this one's very interesting, right? This is a thread on the Greenland Purchase and anything that comes out of the politics of Greenland on whether or not they actually want to join the United States. All right. Hello. I don't think I've seen you here before. ATC. Pretty sure ATC, yeah. All things considered. Gotcha, my man. ATC, yeah, that's a nice thing. All things considered. That's what we want to do with our expectations, right? We want to try and consider all things. It's a good name. All right. So yeah, if you guys want to hang out, Discord is free. Trading group, $100 a month, but it's a 10-day trial, so you can actually try it out and check out these indicators. Get one-on-ones with me if you want to see if this all works. Oh, nice to see you over from WAP. Absolutely appreciate it. Let's see, how much more time do we have until FOMC prints? We have 25 more minutes. All right. So let's go and do a little bit more of a deep dive here into the surveys and what's going on with these surveys, right? So we reviewed that inflation expectations from the Michigan's Consumer Index went insano, and long-term expectations also went to the highest since 1933. Then we had the New York Fed Business Leaders Survey. It's less washed, but guess what? This is also another consumers' sentiment survey that we need to keep an eye on, because this also looks at the future expectations of employment. And you can see employment and wage expectations are coming in lower. So that's not good. And then prices paid is also going. So inflation expectations are going higher. Employment expectations are going lower. These expectations are not good for the Fed's projections if they just stay on hold and say we need to wait, right? Because if these expectations materialize into actually bad economic data, then we're going to end up seeing, okay, the Fed's going to be doing a cut in May at their May meeting, probably, and that would lead expectations back to suggesting 4 rate cuts this year, 100 basis points. And right now, from what I've been reading in a lot of these outlooks, it seems like we're only expecting 2. And it was like earlier, I believe in the month of March, late February, that we had all these expectations. Actually, I can go back here into the central banks chat, and we were actually looking at forecasts not too long ago. Yeah. Now that everyone can do arithmetic, there will be June SOFR 25 if Fed goes more than 50 by summer. So you can see a lot of expectations for a more dovish Fed. So we went from 100 basis points of rate cuts to 75, now back to 50. And we could end up with that path going back from 50 to 75 to 100 basis points of rate cuts if the economic data actually turns out bad. However, again, given the things that are going on in the world right now with, okay, possibly tariffs get negotiated lower before the reciprocal tariffs get put on, okay, maybe we get a more serious ceasefire in Ukraine going on, right? There's quite a lot of maybes. However, the point is that there is good progress and there is good work being done and actually mitigating these risks further as we get more time passing. And until we actually get some kind of confirmation that say the Ukraine war ceasefire is breaking down, or that there is no further updates on these trade negotiations on lowering tariffs, then I see no reason not to expect these higher inflation expectations and lower employment expectations in the US to frankly not get met. We might still see somewhat higher unemployment in the US, or at least, again, this is year ahead. So we'll have to see how well this gets realized, frankly. Again, the next 2 months of economic data are going to be particularly helpful in setting those expectations. So I'm going to be expecting much higher volatility around the next 2 CPI and unemployment data prints. I believe we get US jobless claims on Friday, if I'm not mistaken. Or sometime next week. I did set up streams for next week here. So if I go to content, lives, yeah, Bank of England, S&B, and US jobless claims. So if I untick this, go to coming soon, right? So in 20 minutes, we get the FOMC rate decision and the press conference afterwards. We will be here for this whole time between the rate decision, the press conference, and then yep, right here, initial jobless claims. So we are going to be getting some employment information tomorrow, and we'll actually see, okay, how high are these jobless claims going? Where are these jobless claims coming from? Because if they're just coming from the government side, it's probably not going to be a terribly negative impact, frankly. Because the expectation is that a lot of those people laid off are given packages to leave. Some of them were given packages, some of them were just straight up fired. But the expectation is that these people who are laid off from the US government will transition into the private sector. They'll find some job in the private sector. But with employment expectations lower, if these jobless claims remain sticky and high, again, also over March and April, the March and April data that gets released sequentially also in April and May, then we'll have to set worse employment expectations on that data. Again, emphasizing that the data for the US over the next 2 months is kind of make or break moment for whether or not we'll realize those negative expectations. Alrighty. So if that all said and done, maybe we do end up hitting this original negative expectation way, 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 way down here. I believe that was for the month. If we're looking at, yeah, right there. And then how are the yield spreads holding? They're pretty okay, but it seems like most of the positive yield spread move is coming from the longer duration yields. And the shorter duration, so the 7 to the 1 year, is looking like it's going to flip more negative. So it's not fantastic. Not fantastic to see those short-term yields move lower. Depends on how strong these long-term yields can hold up for whether or not we'll see much more continued upside here on the Aussie. Also, we are seeing China stimulus more likely than not, if I'm not mistaken. I read a couple of things on that. So if China stimulus comes in and it looks well and good, that's going to be a nice little boon to not just the Australian dollar, but also to the New Zealand dollar. Alrighty. That's looking good. Yep, and these yield spreads are looking a lot less healthy, are looking a bit more negative. Again, it's only the long-term 25 days worth of spreads that are keeping things net positive. So maybe this is a pullback, a temporary pullback, and then we end up closing around current prices, but we'll have to see post FOMC today. And then, wow, look at that. Euro is down close to 80 pips right now on the day. It's the biggest red day since this whole trend began, when the German Bundestag and Bundesrat began trying to vote on more stimulus. And I haven't just been taking shorts, I also took a pretty good long here. But yeah, net, if we get peace in Ukraine and Russia, and the deal is that, hey, we're not going to see European or NATO troops stationed in Ukraine, again, that's still up in the wind on whether or not that's actually going to happen. You know, if it doesn't happen, then it's like, okay, where's all this military stimulus money going to go? It's probably going to just go into rebuilding the military there in Germany, because if the ceasefire is they can't send all these troops from all the stimulus into Ukraine, it's like, well, what that kind of defeats the purpose of all the stimulus. Also, it's $50 billion over 10 years. That's one of the stimuluses that's going on. And then you have the debt brake amendment, which it seems like the debt brake amendment's going to pass. There was some legal challenges to passing the debt brake, but I believe the German Supreme Court struck down those appeals to prevent the debt brake from being amended like that. So it looks like we're going to be getting the debt brake amended, and this was the move up on that expectation. So now it's more or less going to be a matter of, okay, now how effective is all that stimulus going to be? Because the expectation is all that stimulus is going to induce more growth in Europe, which is also one of the major reasons why we saw in the DAX this nice, huge little bull run here, right? So now it's a matter of, do we actually see follow through? Does that stimulus actually provide growth to the German economy? Otherwise, if it's ineffective, now the Germans are just more indebted. And if the CDU and SPD and the Greens working together here, getting this debt brake pushed through, and then having like the slim majority, right, in the Bundestag, if they're not able to get much done on effectively achieving growth for Germany, you could end up with another vote for another German general election sometime in the next, 2 or 3 years. Which coincidentally would line up with the US presidential election in 2028. And if it's Weidel and Vance who end up becoming the leaders of the United States and Germany at that point in time, well then, I mean, I don't know if you guys remember when Vance had his little trip and gave that speech to all the European leaders. He went and met with Weidel and said, oh, I really look forward to working with her. So if one day she becomes chancellor and Vance the president, you can end up with a really strong, like, right-wing alliance between the United States and Germany. Like, they could be like really, really good allies to each other, because it seems like Weidel and Vance get along. At least so far, that seems to be the impression. And now that's a ways away and a theoretical, if Weidel's still in politics, if Vance is still in politics, right? But net, people really like Vance. And again, if the CDU and SPD in Germany don't follow through on the growth promises, then you could end up with an even larger AfD party by the next time an election gets called. And who knows, maybe the firewall gets broken down for whatever reason. So we'll see. We'll see. So yeah, I'll go ahead and ask for any commentary from your guys' end. We have how much more time left? We got about 12 minutes before the FOMC rate decision comes on out. Oh, is Levitt speaking? Let's go to YouTube and check out real quick. Let's see here. So, White House Press Secretary Levitt, Trump and Putin agreed need for lasting peace. Ukraine's President Zelensky accepts energy strikes ceasefire. Talks in Saudi Arabia in the coming days. Oh, my browser just crashed. Oh no. Oh no, the browser just crashed. Not good. Alright, let's wait. Yeah, sorry, the music was playing through the browser, so I don't know what's going on with Brave at the moment. Alright, let's go ahead and open our good old friend Task Manager here. Our good old friend Task Manager. Alright, let's force close the dude, and let's get our music back up. Da da da. Oh. Alright. Cool. So it looks like everything kind of crashed, but also everything kind of semi-reloaded here. Oh, that's kind of convenient. Sweet. Didn't have to restart my browser. Let's see here. I can't imagine 60k ATP, not gonna lie. I can see 7270 at best. Yeah, it seems like the downside on Bitcoin, definitely Aristotle over there on WAP, is going to be not so terrible. Again, that's probably the low for the month, right? You can go ahead and likely see. All right, here's our distribution. And this right here is the low in our distribution, right there at a peak. What are PEPs? I'm not sure what PEPs are. Maybe you're referring to pips, which is the minimum tick movement in FX space. I wanted to see if Levitt was live. Yep.
Investigated as incidents of organized terror. I believe the Attorney General has made her comments clear on that. She is investigating these events as acts of domestic terrorism, and we fully condemn them. And as I said earlier to Jackie's question, we think it's despicable what is happening to not just this American company, but also their innocent employees. And again, innocent Americans.
Very important to listen to her.
We condemn it wholeheartedly. Sure.
What is your message to these workers, and can you assure them they won't be fired again as the administration directs agencies to do like that?
Well, the administration is complying with the court's order. Again, as I have spoken about repeatedly, we think it's despicable that we have judges acting as judicial activists, partisan activists, trying to dictate who the President of the United States, the executive of the executive branch, can hire and fire. We have never seen anything like this. We are fighting this in court, and we will continue to fight it all the way to the Supreme Court if we have to. And as for federal employees, it's been the very common sense position of this president and the administration that bureaucrats here in Washington, D.C. need to show up to the office just like the rest of America. Middle-class Americans, from doctors to business owners to teachers to law enforcement officers, have to show up to their offices resources every single day. And the president has made it a clear priority that people in this city have to do the same. And we are also continue to be committed to reducing the scale of our workforce and to reducing the size of our federal bureaucracy here in Washington, D.C. to save taxpayers money. Annie, go ahead.
Generally speaking, if she says anything tariff-related, it can move markets.
Reference the president's interest in helping return Ukrainian children to their parents, to their families. There's an organization that provides intel and information about those children that their aid has been cut. It's a Yale University program that used foreign aid. And I'm curious if, as part of this new thinking with Ukraine,
She's talking about foreign
that
aid
might be unfrozen.
I have no updates about that or that specific program at this time. Karen.
Thanks, Caroline. Just to follow up on your answer to the question on the minerals deal, you said that the White House has moved beyond the minerals deal. What does that mean? Is that no longer on the table?
Nope. It means the minerals deal was that first set of framework that you all saw in that very public meeting with President Zelensky and President Trump in the Oval Office. We are now focused on a long-term peace agreement. As you know, on that deal or that meeting between President Zelensky and President Trump, the Ukrainian president at the time wasn't talking about a greater peace deal. We are now at that place where we are talking about that. So we've moved beyond just the economic minerals deal framework, and we're looking at a lasting ceasefire. Right now we're at a partial ceasefire, but again, the president is sending his highly skilled, intelligent, and experienced team to Saudi Arabia later this week to continue fighting for peace in this conflict. And I would just reiterate one more time, we have never been closer to peace than we are today. Thank you very much, everybody. We'll see you later.
We caught probably the most important bit right at the end of that press conference. Wow. So more confirmation that things are turning out well in negotiations with Russia and the United States. All energy that's affordable, reliable, and secure as a part of the Trump administration, and nuclear absolutely falls in that category.
All energy that's affordable, reliable, and secure is a part of the Trump administration, and nuclear absolutely falls in that category. Here's a great nuclear plant in southwestern Michigan that supplied nearly a gigawatt of power for decades.
This is the energy secretary.
And again, I think was just foolishly closed and shut down during the Biden administration. But that plant should be back online, hopefully by the end of this year. And if not the end of this year, very early next year. Huge benefits.
Wow. That would bring down energy costs a lot. That would really help. Man, imagine a cheaper electricity bill. Okay. Let's go ahead and double check how much time we have until FOMC starts. All right. I got the link. Let me know what you guys are expecting going into FOMC. Alrighty. Game time, boys. Game time. We have this. We have this meeting, the press conference, and the rate decision coming. So let's head on over back here. In 2 minutes, we're going to be getting the decision. I'm going to go ahead and turn on the Financial Juice feed squawk chat. So if you do hear another voice here on the stream, it will be our friends over at Financial Juice. And they will be reading off the countdown until we get the rate decision, and they'll be reading off the rate decision as it comes into them. Lower, not necessarily lower gas prices, technological. It would probably be just lower energy prices in general. Building back nuclear infrastructure and new small nuclear reactors, right, modular nuclear reactors, would bring down energy overall. Actually, nat gas, if I recall correctly, has been on the more expensive side. If I go ahead and check out the watch list here for commodities. Yeah, we've had a rise here. A pretty significant rise for a while. So, energy prices
1 minute
are
remaining. I'll lead with the US interest rate decision.
That's our friends at Financial Juice. We got a minute left, guys. If you are trading it, make sure to look over on your computer for updates in real time because there is a delay on the stream. But stick around. We are going to be watching the press conference, and I'll give little tidbits of commentary when Powell has his breaks, and especially more or less during the Q&A session. When Powell's giving his actual release of the announcement, I'll try and be quiet, but when it gets to the Q&A part, you'll hear me speak a little bit more. So let's check out DXY. And let's go to a 30-second chart.
10 seconds. No change, no change. Rate remains unchanged at 4.5% as expected. Fed medium rate forecast current year 3.875%, 3.875% as expected. Next year 3.375%, 3.375% as expected. Next 2 years 3.125%, 3.125% as expected. But the long run at 3%, lower than forecast 3.125%. So looking to the market, seeing some weakness in the dollar and some strength in the S&P 500.
Alrighty.
So the Federal Reserve unemployment rate has stabilized at a low level and labor market conditions remain solid. The Fed expects the economy to continue to expand at a solid pace. They say risks to both sides of its dual mandate in the statement no longer say that risks are roughly balanced. So again, saying there are risks to both sides but have removed the roughly balanced element. So Fed projections show economic growth slowing in 2025 and inflation remaining further above the 2% target. The projections show that 4 of 19 officials see no cuts in 2025. 4 see 1 cut, 9 see 2 cuts, and 2 see 3 cuts. So Fed projections implying 50 basis points of rate cuts in 2025 and 50 basis points more in 2026. Fed policymakers see 2025 PCE inflation at 2.7%, up from the 2.5% in December, core seen at 2.8%, up from 2.5%. Policymakers see 4.4% unemployment rate at the end of 2025 against 4.3% in the December projections. A Treasury redemptions cap will decline to $5 billion from $25 billion. Monthly redemption caps on MBS is unchanged, though, at $35 billion. The Fed say beginning in April, the Fed will slow the pace of balance sheet runoff. The committee is attentive to both sides of the risks of its mandate. Again, did remove the area where they said roughly balanced.
Wow, that is a move.
So the Fed vote on policy included one dissent from Governor Waller, who supported no change on the policy rate, but preferred no change to balance sheet runoff as well. So again, Fed officials' median view of the Fed funds rate at the end of 2026 is 3.4%, unchanged. So for the end of 2025, they see it at 3.9%, unchanged. Longer run, 3% unchanged as well.
To support a growing and stable U.S. economy. The Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions.
Okay, so
again, Fed policymakers see 1.7% GDP growth in 2025 from 2.1% in December, and they see longer run growth at 1.8% from 1.8% in December.
Online education, publications, and more. These resources are all free for educators to use in their lesson plans.
all right.
Fed policymakers see 4.4% unemployment rate by the end of 2025 versus 4.3% in the December projections. So again, seeing LSEG estimates come out now. US interest rate futures pricing in 56 basis points in cuts this year after the Fed holds the rate steady, unchanged from the prior release.
Okay. Somewhat firming of our expectations. Some firming of our expectations. But that GDP revision lower for the year, not good. Not good for US.
So just again, looking to the markets here, strength in the S&P 500, weakness in the dollar here. SEP showed lower than expected GDP expectations and higher than expected inflation expectations. And the Fed's median rate forecasts were as expected, though lower than the prior December SEP.
Okay, so nothing terribly horrid.
Personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators.
And now, yeah, again, this is the big one. This is the big one that everyone's talking about. This GDP projection getting shifted lower. Might be a bit hard to see, but this is what we had before. And now these bars
Futures
are what we have
imply
today.
that traders see a 62.1% chance of the Fed resuming rate cuts in June, was 57% before the decision.
Okay, so rate cut odds for June went up. Good to hear. Now, we're not done yet. We have to listen to the press conference. So we are far, far from over. No idea. I don't know what it is. Don't know if you're talking about the release here or maybe PEPs or your prior thing here. But yeah, this is the key piece of information. Let's see here. A distribution that participants project for unemployment. It shifted up about 10, 20 basis points here. So not the end of the world there. And then PCE inflation also, like, was more definitively, what's nice about this is even though this is technically higher inflation, there was a larger spread in the December projections, and the spread here is a lot tighter. So there's a bit more certainty around this call with everyone saying, yeah, it's going to be around this much. Versus the GDP figures here that we got where the spread actually kind of increased. Not good. Not good. So a lot more uncertainty on the GDP side of things. And we are currently waiting for Powell to come in.
And issuing and redeeming.
But we have this currently muted.
They also act as a bank for banks. Financial services to banks, thrifts, and credit unions.
Yeah, they keep
also provide a wealth of information.
They're just talking about some basic education stuff. We don't need to listen to that at the moment. A distribution of participants, yeah, for PCE, right? Distribution of participants, judgment for midpoint appropriate for the target. Yeah, seems a bit more hawkish. A bit less of a spread, a bit more certainty of staying closer to where the terminal rate, not the terminal rate, staying closer to where the Fed funds currently is. So maybe 2 rate cuts and then, or no rate cuts, and that's that. So let's go back to the dot plot.
JP Morgan's Michelle says this is a dovish Fed.
Mhm. Somewhat dovish. These dots aren't that dovish. Not until you get into the second half of this year, 2026, right? A dovish Fed would be seeing more Fed officials, more of these dots, expecting 3 rate cuts, or even a couple that are expecting 4 25 basis point rate cuts. That, I think, would be more definitively dovish. This is more neutral to, I would just say flat out neutral. Until we get the data for the next 2 months, we'll be able to more reasonably set expectations for, okay, how's the rest of this year actually going to perform based on how that data is going to realize tariff impacts and immigration impacts in the United States on employment and inflation. And that will generate some clarity for the Fed's policy going forward. And that's a lot of the uncertainty that's being discussed right now in the statements. All right. We are currently waiting for Powell to come up and speak to us. And so far, the S&P has done all right. Let's check out DXY. DXY took a nosedive here. So if we go ahead and start checking out some of the major pairs, Aussie had a good reaction. We can go ahead and hide some of these things here. Aussie had a good reaction. New Zealand had a good reaction. The euro had a positive reaction. The pound had a positive reaction. The CAD technically also had a positive reaction. Yeah, it's doing all right. CAD's doing all right. It hasn't moved as much as the rest of these, though. The Swissy, ooh yeah, the Swissy is doing pretty good here. It hasn't moved a whole lot either. But the one that has moved the most so far, percentage-wise, is actually the New Zealand dollar. Quite a nice bout of relief on the New Zealand dollar here. The one that moved the most on an absolute basis is the euro. It moved about, it's, let's see here, since the announcement, the euro has moved up about 22 pips, roughly half of what it's done so far on the day. So far, so good. And then on the yen side, yep, yen is getting stronger, which I believe is in line with our expectations. I don't know if we'll go this far down, but we'll see. We'll see. This expectation so far has been in line. And the yield spreads are pretty neutral short term. If we check out on the daily, what the yield spreads are doing. Oh, let's go ahead and refresh. Yep. And all these yield spreads are pretty darn negative still, and including on the short term again. So not a whole lot of positive development on that side of things. We'll keep an eye on the DXY. Go to 30-second chart as we go into Powell's presser. Does this mean 3/4 of negative GDP? No. No, it does not. There is by no means in the data right now saying that the US is going to be in recession. Let's go ahead and check out how Bitcoin moved. Again, we got some good news out of XRP today. And it looks like...
As we're seeing from Wall Street Journal's Tim Moreus on X, Fed officials marked down their forecast for GDP and up their forecast of inflation and unemployment, but almost all of them see the risks to the downside being on growth. And almost all of them see the risks to their unemployment and inflation forecasts to the upside.
Yes. So the data over the next 2 months is going to be especially...
Yeah, I've posted out Tim Moreus' article on the feed for those interested.
I can go ahead and pull that up. because I can actually watch and raid Wall Street Journal stuff. Oh, apparently it hasn't saved my login here on Wall Street Journal. I'm not going to log in right now. Does this mean 3/4 of negative, JD? And no. Less growth means China eats our lunch more. Eats our lunch more? No. Generally speaking, if the US slows down in growth and consumption, that's going to directly impact the amount of exports China is able to send out. So China has to preemptively slow down their economy if they want to try and protect themselves. The US consumes a lot of stuff, and Europe consumes a lot of stuff. So if China wants to maintain their 5% growth, as the US is slowing down in consumption, as Europe might be slowing down in consumption, again, the whole point of the stimulus is to try and boost growth. It's not necessarily going to boost consumption because a lot of that is military spending. And spending on green projects, green infrastructure, which isn't necessarily going to impact consumer sentiment and spending in Europe. So it's a situation where you can have worse consumer spending, and that's what you need for China growth. So it's more like the US leads China. So if the US is slowing down, in order for China to maintain its growth, they have to stimulate. They have to do a lot more money spending. They gotta make the money printer go burr, which is currently what they're discussing in China right now. In all of politics in China, that's all they're talking about, is how much stimulus are we going to do in order to achieve our 5% GDP growth target for the year. So it's more like if GDP in the US slows down enough, China doesn't have a lunch to eat. Yeah, I see you, Tech. I got that part. Context clues and whatnot. All right. So Powell is going to be speaking in about 15 minutes here, so stick around. We're going to go ahead and see how Bitcoin has responded very similarly, actually. It rose up, dipped, and has so far recovered. So far, so good. So we'll see how the rest of these assets hold up going into the FOMC meeting. Yeah, CAD hasn't moved down as much as the rest of them, have they? CAD hasn't gained as much strength as the rest of them. Do we expect to love or hate Powell today? Well, that depends on the color tie he's wearing.
So just a heads up for users, we have posted out the live feed of the press conference, which is due to start at the bottom of the hour with Fed's Powell.
Thank you, Financial Juice. We already got that open. I'll go ahead and stop the audio over there on Financial Juice's end.
Voice news disconnected.
That was very, very helpful. And when we are done with the press conference, we'll turn them back on, see what they got to say. If there's been any major changes to the Fed funds rate, pricing expectations for future rate cuts, rate hikes. We'll see how closely Powell's messaging here at the conference lines up with what was said here during the SEP, in these SEP projections. So hopefully the Q&A section for this meeting is particularly enlightening. And stick around. We got about 12, 13 minutes left to go until Powell hops in. So now is a perfect time if you want to do chart requests, if you want me to check out some stuff with the indicators that I have. Now is a very, very, very good time. And it's not just FX that I look at. I have crypto, equities, commodities, bonds, all the major asset classes here. So if you need me to check something out, actually we can check out NVIDIA. NVIDIA has responded phenomenally to the FOMC meeting today, recovering a nice, decent amount. Let's go ahead and check it out on 1 hour here. Yeah, you can see the hit it's had recently. It has not been holding up too well. Hopefully, we'll see some maybe more hopeful growth expectations out of Powell. Hopefully, he's not overly pessimistic about growth. But yeah, all these equity indices, you know, ARK is up even today on that announcement. And look at the fall that ARK has had since the middle of February. It's totally reversed the move up it had since Trump was elected. This whole thing going up was Trump getting elected. Oh man. Yeah. And this is all the growth scare stuff. So now we'll see from here if we get another rally higher in ARK. Let's go ahead and check out a bunch of other stuff. Yeah, wow. Disney, Capital One, GM, Stellantis. Well, Stellantis is still getting hit super hard. Ever since, I believe, yeah, here. Ever since Stellantis is just, oh man, $28. That is, they just keep getting hit and hit and hit. Chevron in a nice consolidation there. Check that out. Sticking between 130 and 160. And Apple is holding in there, generally better than the rest. Let's see how Apple responded to FOMC. Positively on the announcement, negatively on the follow-up, and then after that immediate follow-up, buying back. So far, so good. So far, so good. Let's see here. On the commodities side of things, yeah, nothing too crazy. Oil's down, what, 40, 50 cents? Closer to 30 cents. And how about gold? Gold is doing quite well on the announcement. So this was when the rate announcement came out with the SEP report, and we've just seen more follow through on gold here. So gold has continued to perform well. It's up about $10 since the announcement. And again, I think Bitcoin is doing pretty okay. Yeah, it's pretty much flat. It's had quite a bit of volatility in both directions. And yeah, the DXY has been down, but now it's holding, going into Powell's presser, which is in about 9 minutes. So we will likely, depending on how Powell speaks, gives us some more volatility. That could be dollar bullish, could be dollar bearish, depends on what he says about the outlook, growth, and how much uncertainty he has about inflation and employment. However, given the focus on growth expectations, well, that's going to be the big one. And a lot of that is tied to tariffs. But again, like we said at the very beginning of the stream, depending on how well this goes down with Hassett getting tariffs mutually lower before the reciprocal tariffs go into effect, and how close a full-on ceasefire gets agreed to. Again, the Russians and the US, they're meeting again in Saudi Arabia sometime apparently over the weekend. So we'll be getting more information here. And the closer we can get to peace with Russia-Ukraine, the closer we can get to not having insanely high tariffs from the United States get put on to all these other countries, the more likely it is we won't see such a huge jump in inflation, huge jump in unemployment, and we could see the negative growth expectations set even here over by the Fed, right here in this chart, actually come in a little better. Probably just under 2% or right at 2%, depending on how well things go. Again, this is year ahead expectations. The latest upcoming GDP report for Q1 is probably going to be on the more dour side, to say the least, simply because of the amount of imports going on into the United States to compensate for tariff expectations and how strong those expectations were. So a lot of people built up trying to protect themselves from tariffs, doing a bunch of business before the tariffs went on. And now it seems like, okay, these tariffs aren't going to be so insane. Except maybe in the scenario for Canada, frankly. It doesn't seem like Mark Carney, the new Prime Minister of Canada, is going to play ball with the United States. He wants to try and circumvent negotiating tariffs with the United States, it seems, by trying to build new trade deals and negotiate with European countries. So we'll see how successful that is for Mr. Carney here. And we'll probably get more information on that over the next week. Specifically because he'll have to, because next week on Monday, the Canadian Parliament comes back into session, and we will see how much Carney is attacked or how much Carney is supported by the different political parties over in Canada. And who knows? It would actually be quite hilarious if on the very first day Parliament comes back, we see a vote of confidence. And we'll, and see how close that comes through or not. It'll be an interesting and dramatic session, definitely, for the Canadian Parliament. And if you would like to follow those political developments, you can go join the Plan the Profit Discord over here in WAP. Just go to WAP/Plan the Profit. Links are pinned and all that in the description, in the chat, pinned, all the good stuff. And you can see that'll take you right here to the Plan the Profit channel. And right here, we have the 45th Canadian federal election. And this is a bunch of updates and a bunch of news and developments in Canadian politics. So if you don't know much about Canadian politics, go through that thread. And if you want updates, and you want to share updates also, go ahead and share them in that thread. It'd be very much appreciated. So we'll go ahead and keep an eye here on the DXY, because Powell should be speaking here in about 4 minutes. So really stay tuned and stay here with your eyes on the chart, because we're going to be seeing Powell here rather shortly. I'll go ahead and send out another announcement when Powell is live. So let me write that up in the Discord. Very peaceful music. Yeah, do we expect to love or hate Powell today? Depends on the color of his tie. There's this whole conspiracy theory that depending on the color tie Powell wears, he gives out different signals about how dovish or hawkish or neutral he's going to be. Now, I don't have the data set to know which color tie it is, but it was a very interesting theory that I heard some other traders talk about for a while. I mean, hell, even back during the first Trump administration, people were talking about that. Nice to see you, Braveheart, over there in the WAP chat. Message might be 30 minutes old, but better to say hi now than never. All right, Powell should be speaking imminently. He should be coming out to speak pretty much right now. Go ahead and send that announcement out. No worries. Yes, thank you very much, Brave. All right, the music gets turned down. Powell should be speaking with us now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time.
Q&A.
So, two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the five-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. You know, we do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But you know, given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. You know, I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth. From 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, you know, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other? In
labor and inflation, just across the economy. Have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture. Because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the pandemic.
You could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the time frames and all that. And we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and the high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. at that point. We'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, And unemployment is really, there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is once I guess in June. Was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down, they tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil. Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Can I do a quick QT question? Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. You know, sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, you know, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. I'm sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, you know, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. You know, the real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, you know, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, you know, we don't want to get ahead of that. You know, we want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, you know, higher levels to pretty close to 2%. While the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, you know, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. You know, inflation, underlying inflation is you know, still running in the 2s with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
You know, it's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France-Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those. And so that's kind of baked into the numbers. What happens, it will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News.
All right. MNI.
Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. It slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
All right. Wow, that was actually a pretty good presser. We got a lot of useful information, and net, I'm pretty certain that our expectations overall matched with what was actually said at the meeting. All right, let's go ahead and check out how things have moved over the hour. Dollar fell, and then it has rebounded about half of the move. It's not a particularly volatile move here on the DXY side of things. So the dollar net pretty stable, still up on the day. Let's go ahead and check out some of these other assets. Let's check out the euro. It's going to be the opposite of DXY. Aussie holding up better. New Zealand holding up pretty darn well. Pound looking pretty similar to the euro there. And the dollar CAD. Dollar CAD's holding up. It's a bit weaker than the rest of them because of tariff and other political things going on in Canada. And the yen is strengthening quite well, on its way to follow the expectation. We'll see how close it actually gets. And let's go ahead, go to daily chart, over to euro dollar. And let's check out our yield spreads here. All right, yeah, yield spreads are still pretty bullish on those long-term ones. So we'll have to watch how those short to intermediate term yield spreads move on that front. Let's check out equities, see how things have moved. All right, S&P doing well on the day. I think the key thing is there, and this was even brought up in the chat. Hey, Harold, nice to see you. It was brought up in the chat, is this going to cause a recession, a depression? And it's not just only here in the stream chat, it's also all these commentators talking about, oh man, GDP's going to slow down so bad. This is going to be persistent. This is going to be horrible. And Powell, in line with the review we had at the very beginning of the stream, going over the business sentiment reports, right? All these surveys, so many of the questions at FOMC today were focused on these surveys, but because we knew what Powell's expectations were going into the event, how he actually interprets these things, because, you know, we are actually doing the research that we say that we're doing here in the Plan the Profit Discord server. If I go ahead and I bring it up over here, there it is, right? Here's the central bank's chat. And so far, so good, I'd say. I think we did a pretty good job. And if you want to get into the server and check out some of these indicators, go to Plan the Profit Community. You're on WAP. And there's also free indicators available here on my TradingView account. You can just go ahead and find my account, Joe Boss. Man, that was a pretty good FOMC meeting, all things considered. Lined up right alongside our expectations. Yeah, African time. Hope FOMC has been kind to you. Yes, it has actually. It's been a pretty low volatility FOMC, frankly. And the fact that the Fed isn't doubling or tripling down on a lot of the concern going on in the economy from these surveys is probably going to give people the thought of, oh, maybe the Fed's making a policy decision, and it's probably going to bring more people like me out into public discussions and in the outlooks, where we aren't necessarily, I'm not necessarily so bearish on the economic data until I see it. We'll be getting more employment and inflation economic data coming out later in April and later in May. Plus, we'll be getting the retaliatory tariffs put on April 2nd. We'll be getting a lot of information and a lot of the final decisions on these tariffs coming in over, frankly, the next 2 to 3 weeks. So we'll have a much clearer picture of how the U.S. economy, what kind of strength, what kind of growth, what kind of employment, what kind of inflation we'll have going into the summer. And at that point, it'll be clearer to set future expectations and have less uncertainty. And vis-a-vis what BlackRock said not too long ago, right, in the equities channel, hey, over time, deleveraging will have run its course and uncertainty will likely ease as we get more policy implementation details. Simply put, volatility might be decreasing here over the next couple of months, as we finally get confirmation on some economic trend directions. And also, you know, the stuff with the Houthis could actually impact inflation. It could actually reduce inflation in these other countries that the US is doing trade negotiations with. And this thing going on with Hasset, right? Trying to get better mutual lowering of tariffs between countries that are expected to have reciprocal tariffs hit them. We'll see over the next 2 weeks what the final tariffs might end up being. And my expectation is that the countries who are not willing to go through those tariff negotiations with the United States and mutually lower tariffs together with the United States are probably going to have their economies hit harder than countries that do those negotiations, that do lower those tariffs with the United States. So that would be my expectation going into a lot of this stuff here. Yep, and we'll see how well all these expectations line up over the next few days. We do have the Bank of England meeting tomorrow and US, I believe, initial jobless claims tomorrow. So it'll be interesting to see how the pound reacts. And also we have the spring statement coming out, which is going to be introducing more taxes. Yikes, you know. It'll be interesting to see more or less what the Bank of England is going to say about the spring statement and how they're going to adjust their policy based on the upcoming expectations they'll have for things going into the spring statement. Now, there's uncertainty about what will be in the spring statement. You know, we won't know until that actually comes out. But I don't think that uncertainty is going to be especially positive for growth and the BOE's policy, to say the least. So, to answer that question, do we expect to love or hate Powell today? I think he did good. We set good expectations for what Powell was going to say by properly researching what he was going to say ahead of time. He came out with the consensus view, mostly, and he lined up pretty much with exactly what we were thinking was going to happen. I think, net, we did a pretty good job, and this was overall a pretty productive stream. If you guys have any questions, now would be the time to ask them. I'm also checking out here the chat and WAP. He's a great politician, but a terrible economist, proof of Prof Yapper. I don't know, man. I think he did a pretty good job there. Don't get me wrong. There are the money printer go brr memes, right? Oh, transitory inflation. Right? Oh, man. Transitory inflation during COVID. That was such a mess, right? However, I think Powell is right in discussing, hey, transitory inflation here in this current scenario is not going to be as insane. It's not going to be as insane as it was in COVID. Now, generally, transitory inflation can be thought of like, oh, it's going to stick around for 3 to 6 months and then start declining from there. That's not what happened with COVID. With COVID, it stuck around for like 1 to 2 years, right? It was not transitory. And a lot of that was also Janet Yellen's fault, the Treasury Secretary at the time. So now we have tariffs going on. As Powell said, during the last time we had the tariff inflation impulse, right, come through back, I think, in the 70s in the United States. That was a transitory bit of inflation that lasted about 3 to 6 months, I believe, if I'm recalling correctly. And that's effectively that's the consensus. Like, most people who I read, that's what they expect. Unless you read the people who are expecting tariff wars, where countries are fighting each other over getting the best prices for their tariffs with the United States, there's no inclination that's actually happening anywhere effectively outside of Canada, frankly. Canada seems to be... And Canada really stands a lot to lose by not trying to play ball with the United States. They'll go ahead and make them a state if their economy crashes hard enough. Oh man, yeah, Canada needs to protect itself and just be good friends, right? Try to get past the Trump administration without becoming the 51st state. Alrighty, I don't see any more questions. I don't see any more comments and whatnot. So I'll go ahead and end it here. I'll say thank you guys for watching all the way up until the end. Remember to like and subscribe if you have, and follow. Check out the other social media sites. And remember, in the pins of all these comments and all these descriptions, you can get access to the Discord channel where we do all this trade research for free. And if you want access to the indicators that we use to try and help set our expectations for a lot of these assets, you can go ahead and find them here in the Boss Trading Group. Try them out for 10 days. And yeah, look at that. Nice low, right? Nice low caught with the indicator. Alrighty, you guys. I will see you all in a bit.